I'm Foreman, and in this video I'm going to show you how to find high growth stocks in the stock market by identifying the traits or qualities to look for that I use in my own personal investment strategy. And if you like the video, please drop one of these to beat that YouTube algorithm. It's much appreciated. It's important to note that I'm not a day trader or really much of a trader at all. I don't base my investment strategy on technical analysis trying to predict whether the stock is going to go up or down for the day, month, or even year. Instead, I like to look at the underlying fundamentals of a business to then see how they may compete in their industry and whether that industry has long-term growth potential, because at least at my age of 21 years old, I feel that I could have at least a few decades to invest. And so if a share is down for the next few years that I hold it, that gives me a lot of time to build up a position with regular deposits, as I don't have much money at the moment, but I have a consistent income stream. I can build up those positions as the share price is down, and then have a large position for the future in which I still think they will benefit. The first thing I look for before even looking at the underlying fundamentals of a business is the company's info. What do I mean by info? Usually there's a small blurb, so you might search up the name of a company. For instance, you might search up the likes of Games Workshop, one of my holdings in my portfolio. Games Workshop might say that they retail miniature figures and resell books based under their Warhammer brand and also Black Library subsidiary. This piece of information then tells you, okay, so they are selling these miniature figure tabletop games and that this is what they target primarily. Is this something I can understand? I think so. I think it's quite a community-based hobby. I can understand the aspect of the hobby, and so I feel this is quite an easy to understand business, and so in the future it shouldn't be complicated as to why you may believe that the earnings will continue to increase. If they're not easy to understand, what makes you think that others will believe they're easy to understand? This is where it gets a little bit more tricky and more subjective. But I've heard stories where, for instance, institutions have multiple teams researching companies, and I believe they tried to research the likes of Rolls-Royce and still came up that they were very much unsure on the whole idea. Now, this might just be a myth and something I've heard from absolutely nowhere, but it puts something into perspective. If you have a niche understanding of a business or industry, then that will likely be your advantage in buying these shares, as I personally like to buy before the institutions, right? So adopt these shares or get them in your portfolio before the big institutions have seen them on their radar. And so I like to go for those smaller companies. But the idea is here that if you have that niche knowledge, you know exactly why a complex engineering company based on elevator safety systems is going to grow in the future, perhaps a further demand for elevators as they are pioneering technology. I'm just making this up. If you know exactly this, and that's why this company will grow, and yet the market doesn't see this, then you've got a very strong investment thesis based on the info alone, or the information. Then I'd look to see whether I think this company will grow in the next 10 years. Do I think this stock will do well, or do I think the industry will grow in the next 10 years? And then do I think this specific company will outcompete the others? I immediately rule out any energy or commodity-based businesses. This includes oil. I do not like oil, but I don't need to go into that in this video. For instance, that's because I lack this crucial understanding that I feel that's personally necessary to buy these investments. You might think, okay, why? Let's look at commodities. These could be, for instance, a platinum mining company like Sylvania Platinum that I mentioned in my June stocks to buy card at the top right of the video. Sylvania Platinum is a well-run company, has very good fundamentals, although I don't know how well the platinum group metals will do in the future. And instead, unfortunately for SLP, their revenue and earnings in the future is based off of the price of platinum group metals, and they can't control this price, meaning that they can't organically grow due to the price increasing. They have to either mine, export, or time the markets of when they sell their PGMs. So it makes it a little bit more difficult for these companies to then strive in the business environment, and it's likely why they hold lower price to earning ratios compared to other different styled businesses. And then since I don't know what commodities will do in the future, sure, we may use a lot of lithium now and it may be looking good for electric vehicles in the future, but then we may have innovation and that might say actually lithium is more expensive than this new material we've discovered, and this new material much cheaper, and it's much more ethical for the environment. And so I don't like to gamble on that. I would say it's a gamble because I don't know I can't predict an outcome for the likes of commodities without just saying, oh, I think gold will hit $2,000 per ounce. I don't know that, so I'm not going to invest in them. A new step I've added to this strategy, and it was pointed out by someone in the comments sections, and I'm sorry as it's very difficult to find this as it was a few months ago. However, they wisely pointed out that it's a good idea to look at the company's website. Not just the investor relations where you can see the annual reports, but rather the public part of the business page. This gives you a good gauge of the consumer audience. Who are they targeting with their website? What kind of business are they looking to achieve? And this is very easy to spot red flags, as it's very likely if you're watching this video, you may frequently use the internet. You may look at a lot of websites. You've probably seen thousands, if not millions of websites over the time of you using the internet. And so you could look at these websites and identify whether these are actually good websites or if actually, hang on, this website doesn't seem very functional. Perhaps there's something that they've missed out on, or perhaps they're really not putting much money into their online business, and this could be a red flag telling you not to buy. There's many things you can look for with that, but I think it's an important thing to keep in mind. And if you didn't already know and you're interested in full portfolio access and my live trades in my stock market portfolio, then check out my Patreon, link in the description down below. Then I like to look at the balance sheet, as this is a very easy step that I can rule out a lot of companies and it does not take much time. The balance sheet, what I look for is, well, I used to look for absolutely zero debt. This will find you some of the highest quality companies. However, usually when they are of that quality, the market has already identified them. For instance, Boohoo, whilst yes, they are relatively undervalued to what they could be, they are still a large company compared to where they were 5 years ago, with a run up of around 700%. And so if you look for companies with a slight bit of debt on the balance sheet, or that they're consistently decreasing it year on year, or if they're strategically putting this debt to use so that they're effectively growing faster than they would without it, then I think these would be wise reasons to add it. And so if I were to screen, I think I'd put maybe a 25% debt to equity ratio and then look for ones that are decreasing in trend. However, if they have much more debt than that, then it's already a no from me. But then I also like to look at their cash position. I would like them to have a lot of cash, and you can't really specify a number on this because it really depends on the size of the business, how profitable they are, and it makes it a lot difficult. However, I like to see immediately. If they've got more cash than the debt, great sign. If they have a lot of cash available so that they were unprofitable and they could continue to survive, that's another good sign. Any surplus cash could be used strategically to invest in other companies. They may decide to buy or to make acquisitions, mergers and acquisitions activity with that capital, and they might have that opportunity simply because they have cash on the balance sheet. So I really like to see that, especially as in the last 2 years due to the pandemic. It's good to see companies starting to build emergency funds in the off chance that there is an economic uncertainty, they can weather out the storm. In my opinion, the next most important thing is then their underlying financials. I'm talking about earnings and revenue here. I like to look immediately. Are they profitable? Have they got positive earnings? If not, that's okay, because if they're not profitable, I look for a growing revenue, a consistently growing revenue, and perhaps a fast pace, and also a positive free cash flow. If they're growing revenue but losing earnings and negative free cash flow, I immediately just throw it away, because at that point it's more speculative than what's on the fundamental balance sheet. And so whilst there might be a lot of investor hype, people saying, oh, this stock is going to go to the moon, you're trusting other people's opinions, and I prefer to rely on my own strategy. And so I would completely ignore that investment and just scrub it away. I'm fine missing out on these opportunities that might 10x, because I'd rather be invested in companies I can understand and have a reason as to why they will 10x, other than the share price is $1. Now it must mean it's immediately going to be $10 in a year. It's so easy. But yeah, sorry, I digress. If they are profitable, how high are their margins? Usually the higher the margins the better, but even if the margins are fairly low, are they higher than the likes of others in the industry? That presents a competitive advantage and could be very useful in this stock, beating the others in that industry. Furthermore, if these margins are scaling with revenue, if not increasing, this is also a very good sign to see. Revenue increases, but the margins get higher or they become more profitable, a very, very good sign, and I love to see it. As that means as they become a bigger and bigger company, it really means that they're going to be earning even more money. So because of their scale, scope, and size, they're able to dominate, lower their costs, and therefore have much more profitability. This, I believe, is very good for dividend-styled companies, but it's always good for growth companies too if they were reinvesting their free cash flow into acquisitions. Ideally, these financial metrics would help identify if a company is strong with consistent earnings, or without specifying compound annual growth rate, because if you start specifying CAGR of earnings or revenue, you then rule out a lot of companies that could just be on that upwards trend and doing a lot of work. And so I don't like to input numbers into that category, because they may have 24.9% growth each year, but you want 25% or above. It also rules out the ones with lower track records or makes them a lot more volatile. And so I just like to avoid putting any hard numbers into it. And then it means I may have to search for a larger sample size, but then at least I can check and see how they're doing. I personally think future analysts and what they think of what may happen to the future of the company and their growth is of little, if not any, importance to me. I really don't care about it. This is because I feel analysts, whilst they are paid to do so and it is their job, and in the past I had been perhaps more negative of them, I feel that they still have their own agenda. Whilst they are analysts, they're not helping you decide the investments in your portfolio, so I take it very much with a grain of salt. If the analysts are forecasting great growth in the future, cool. If they're not, I will look a bit more into it and see what they have. I think the bear views of analysts are much more revealing than the likes of the bullish views, but I still think that it's not that important to me. But then again, I'm just speculating, and that's because I would only really trust myself to make these decisions, and I would like to look in the past to identify what trends they have. And whilst they say that yes, you can't drive whilst looking in the rearview mirror, you can identify where the road has been and where the road will go from briefly checking. And so I like to look at the past to see what they could be doing in the future, but I think that's mainly in reference to the past performance of the share price, and that's something I don't base my investment research on whatsoever. I am not a value investor either, as you can see from the title of the video. Value stocks are interesting to me, but I haven't perfected a strategy for this, and so price to earnings ratios, price to book ratios, PEG ratios, price to earnings growth, are not important to me. If a company is good quality, I mean very good quality, and they're trading at a premium valuation, I'm happy to buy shares. I can just keep buying shares, and perhaps they'll start to lose that premium valuation. That's fine, because then I can keep topping up that position, build up with that consistent cash flow I'm depositing in my portfolio, and really create a very strong portfolio of stocks and have a good base position. And that's mainly because I don't have the lump sum capital available now, but if I did, then perhaps it would be less of an important factor to me, or more of an important factor to me. I do also take note of the market size and how much they could really top out on, and the size of the market capitalization of the company. If the market capitalization of the company is very large compared to the market size, this may mean they have less scope for growth. And whilst this might be a promising industry, I would likely look at smaller players in the industry that are perhaps disruptive and clawing up market share. There are some things you can't look for using screeners though, and that would be the likes of a large moat. A moat that means that it's hard for other companies to take their market share. They may have very, very high margins, and they may be very well expand across the country, meaning that other companies may struggle to keep up with their lower costs and, for instance, be able to grow as effectively. Also, high barriers to entry in the industry. You can't really tell that just by looking at the fundamentals of a company, although you can tell once you've had a read to see what they do and to see what other companies are around. And also the likes of a good quality management. You could look at the likes of return on capital employed, etc., but it doesn't really tell you how good the management is and what they're going for. That one is a difficult one to find out, and it's more or less looking about what the management have done and whether you agree with their decisions. And if you have, that might mean that they are a good management, but then that could lead to a form of bias. And so it's a very grey area per se. If you'd like a free share up to £200, click the Freetrade link in the description down below and sign up using that link so that you can get that free share. Then if we go to a stock screener, I would specify a fair few things. Firstly, I'm going to specify London Stock Exchange and AIM markets because that's where I invest, even though the London Stock Exchange does encompass the AIM markets. Then I'll be looking at your debt to equity ratio. I would like to look for 25% or less. I would like to look for a lot of cash, but if I can't specify that, that's fine. I would then like to look for higher margins. If that's not something you can specify, that's also fine, because you can get high quality companies in industries where high margins are hard to obtain, but they have higher margins than their competitors, and so perhaps it's not as important. And usually I'll filter by industry. I might think in the next 10 years, E-commerce is going to do very well at selling products online as more people find it more convenient than going to the high street, for instance. I might think because of this, it's going to be a higher trend in financial technology. These fintech payment providers are going to start making more money because more people are buying online and therefore might be using their security services or whatever they may offer, and they will be making more money. Then you might also look at other things such as more cyclical stocks. No, let's not go there. But then you might also be interested in the video gaming sector. You might be interested in esports. These also may become more popular as more people access the internet and perhaps play video games. They might have noticed in the last year that actually video gaming is a cheap hobby. This cheap hobby is more entertaining for me to play a couple games of Warzone with the lads instead of going for a few beers down the pub, although you could still do both at the same time, even if you really wanted, but not probably Warzone at the pub. Point is that there's definitely sectors in the future that have growth, and so if you filter out the ones that you don't want to look at, like energy companies, or in my case, or just companies you just don't understand, then it can really help out and filter to exactly what you need. So I'm going to run a stock screen on the computer and I'll be back to show you what I've found. So I've jumped on Simply Wall Street, one of the services that I use and I've used for the last year and a bit. There is a review that I can put at the top right of the screen for you. And on my screen, I can see that I have filtered by market. We've got the AIM and LSE markets, as I mentioned earlier. We've put a lot of industries in, such as tech, entertainment, media, such as publishing, and the likes of software, financial technology, if I've added it, advertising, all of that, and I've added that into the industries. Then for filters, there's not many. Simply Wall Street is quite limited on that. What I've said is that companies with a market cap of less than $500 million, it's in dollars, which is a bit annoying, but that's okay. I've also went for the likes of a past 5 years earnings growth. I've just put more than 10%. So that it just filters out the companies that aren't really growing much, but then it can be much higher than that, if so. And I've also got a low debt to equity ratio of 25% or less. Immediately, the first few companies that have popped up on my screen, best of the best. This is a company that I would own in my portfolio without a doubt if it was on Freetrade. I've mentioned this in the past, and it was on my June stocks to buy as well. We've got Cerillion. This is a company I've got on my watch list, which is in my Patreon. You can check that out, don't forget. And that was one that has gone up significantly since I've even kept an eye on it. And that's, I believe, a fintechnology company, provides software for billing and charging. We've also got the likes of Blanco Technology Group. I'm not sure quite what they do. I've not seen them before, but they might be an interesting one to look at. We've got SDI Group, a company that I think is very promising, is also on my watch list, and it's one that could present a lot more growth than Halma, but also that same consistent stability that you might be looking for in a portfolio. There's also the likes of Calnex Solutions. Another YouTuber, Journey into Stocks, has held this company, and I believe he's gotten quite a multi-bag just from buying it, and it's to do with the 5G play. That's a good one. They have a lot of profitability, good balance sheet, and many other things. And then as we go down, it goes into much, much smaller companies, and there's usually a limit. I probably should have put a bottom line onto it, as if you get to companies with about $5 million market cap, they become a lot more volatile, less liquidity, and perhaps a lot more risky. But there is the likes of Arcontech. I believe that's another one on my watch list as well. I thought they were interesting, but I didn't quite understand the whole part of them. It would just need a little bit more research, is what I feel. And so I feel that these kind of trends can help identify high growth stocks for the future. Obviously, the screen is not enough. The screen would be the basis of my research. I've then identified best of the best. I would then research that further, which I've done in the past. And then I would look to see, okay, how the management is. Look at the annual reports, the investor relations. What have they done? How well have they done? And what can they do? Obviously, I know best of the best is quite promising due to their app launch and how it only takes 2 months of Facebook advertising for them to make their money back from repeat customers from those advertisements. It's quite incredible. Obviously, there are other things that I may not have included that you can look for in a stock screener, and feel free to add that to the comment section down below. These are usually just the core things I look for in my investments, and then after that point, I would look elsewhere. And that's where it becomes a lot more niche, and I feel that a screener perhaps isn't as relevant. If you're interested in my stock market holdings and which UK stocks I bought this week, then click the card at the top right of the video. Thank you for watching. I'm Foreman. Have a fantastic day.